Friday.
Well, this wild ride has certainly been a gain for those small investors who are pushing the price up. But meanwhile, hedge fund managers are being forced to sell at a loss.
Daniel Rogers is an associate professor of finance at Portland State University School of Business, and he joins us now to explain exactly what is happening here. Thanks for being with us this morning.
Good morning.
Well, for
Glad to be
those
here.
well, for those who don't really know what's going on here, explain what happened briefly with GameStop and how short selling fits into it.
So, if you look at GameStop about 6 months ago, stock was trading at around under $5 per share. And there were some things in the company that caused stock price to climb over the rest of 2020. And by the time we started the year, it was around $20 a share. And then a couple weeks ago, really this whole phenomenon started in which folks started realizing that there were a lot of short sellers on the stock. And there's this online forum on Reddit called Wall Street Bets, and they basically have been able to mobilize, in essence, an army of long traders that are willing to buy the stock, and they're really looking to force the short sellers out. So the basics of short selling is, basically these institutional investors borrow shares to sell them, and then they're hoping that the price will go down. But if enough buyers come in and start forcing the price up, those folks are forced to basically buy the shares back and take a loss. And that's really what's been going on in simple terms over the last couple of weeks.
Yeah, so it's essentially, some of these Redditors were gambling and that gamble paid off. I mean, should the average person be jumping in and investing now? We're seeing a lot of people who are watching this in the news and wondering, well, maybe I should invest in GameStop. Is that a good idea at this point?
I would say no. The interesting thing about this Wall Street Bets community is you get the sense that there are some folks in there that really know what they're doing. And the risk is if, when, these kind of frenzies start happening, people start saying, oh, it's gonna keep going up. And they jump in. And the reality is, I can't say this with any certainty, but the excitement may be over. As you pointed out, the stock is down a day. We have seen other periods in the last week where the stock was down, but then bounced back up. But it seems to have hit a plateau. And there's a significant risk that it could go back down to the levels that we saw before January. So it could easily go back below $20 per share, maybe between 20 to 50. I don't know. I mean, that's above my pay grade. But the essence of the matter is the stock probably is not worth $300 per share. And the risk of the folks getting in now is that they could end up losing significant amounts of money. So my message is, if you can't lose it, don't bet it.
Well, there's a reason that institutional investors were short selling GameStop. So what does this mean for the company itself? They've got this big infusion of money from everybody wanting to buy the stock now and the stock price rising. So what does this mean for GameStop?
Well, GameStop is going through the struggles associated with a changing business model. They own brick and mortar retail stores in which they sell and rent games and gaming equipment and such. And the whole industry is moving more online. And so they're, like any brick and mortar retailer, they're having to pivot. And so their big issue right now is how do they do that effectively? So one of the things that's been, kind of chatted about amongst, people that know what they're talking about is like, hey, why isn't the company issuing new shares to raise capital? Because right now, all this trading really doesn't do anything for management. It's just a distraction. But they could issue new shares. But given all the volatility in stock, the question is, well, what price would be reasonable to issue new shares at? And also, if there is a big decline, would that create negative publicity for them? So there are some risks, but fundamentally, they could look at this as an opportunity to raise some capital to help invest this pivot into more of an online business rather than the brick and mortar.
Yeah, it is interesting, but gosh, if you had asked me a couple months ago what economic and financial news would be talking about in 2021, I would not have guessed GameStop. I'll just say that. Daniel Rogers, Associate Professor at PSU, thanks for joining us this morning.
Yeah, thank you.